Visa trades at approximately $369 per share for a market value of $688 billion. At that price, our reverse DCF implies approximately 15% annual unlevered free cash flow growth for the next 10 years. That price-implied path takes estimated unlevered free cash flow from $22 billion today to $88 billion in year 10, 4 times the current level. Over fiscal 2022 to 2025, reported free cash flow grew by 6.5% per year. That is the delivered record beside the price-implied 15% annual growth path. Can Visa sustain this, or is too much growth already priced in? To answer that, we run the valuation through 3 lenses. A reverse DCF reveals what the current price already assumes. A traditional DCF estimates what the business could be worth under bear, base, and bull scenarios. And a price-to-earnings multiple adds context from comparable historical and market anchors when those are available. 3 lenses, 1 conditional verdict. We model Visa's cash engine as volume to net revenue, yield to op, margin to free cash flow. The template's proposed defense is universal acceptance. Hundreds of millions of cards are already in wallets. Hundreds of millions of merchants already accept them. Dislodging that 2-sided network would require replacing both ends at once, which almost never happens. For an upside case to hold, 4 things must be supported: spending volume, yield stability, international growth, and return on capital. We will test each one later. Visa's stock has materially outpaced the market. That helps explain investor enthusiasm, but not whether the current price is justified. Over the last 3 years, revenue grew approximately 10.9% a year, earnings per share grew approximately 16.5% a year, and reported free cash flow grew approximately 6.5% a year. One gap stands out. Earnings per share grew far faster than reported cash flow. Share buybacks explain a measurable part of it. The count has fallen roughly 2.5% a year. The remaining gap can reflect working capital, cash taxes, capital spending, and accounting timing. The data here does not assign it to one cause. Because this model values estimated unlevered free cash flow, that is exactly the gap we have to watch, not the headline earnings number. Reported free cash flow margin moved from 61% in fiscal 2022 to approximately 47.2% for the latest trailing period. In the quarter ending June 2026, revenue grew 14.4% year over year, broadly in line with its recent trend. The question is whether that continues. The capital behind that growth has earned well. Our accounting estimate puts Visa's latest normalized return on invested capital at roughly 36%, comfortably above the 10.4% cost of capital. You can see it on the chart. The stock materially outpaced the broader market over this period. That relative performance is useful context for the valuation, not proof of fair value. But recent growth is the starting point of this analysis, not the forecast. The question is never what was delivered. It is what the price now requires. At the time of this analysis, Visa trades at approximately $369 per share for an equity value of roughly $688 billion. Estimated trailing unlevered free cash flow is approximately $22 billion. A traditional DCF starts with forecasts and calculates a value. A reverse DCF does the opposite. It takes today's value and solves for the growth rate that makes the price possible. We use a discount rate of 10.4%. The company's estimated cost of capital, terminal growth of 2.5%, and the company's estimated unlevered free cash flow base. One adjustment first. Visa carries net debt of about $10 billion, so we solve against enterprise value rather than the headline market cap. The result on these assumptions, today's price, implies approximately 15% annual unlevered free cash flow growth over the next 10 years. The market's math under our assumptions, not a fact. And the required growth remains demanding. Across reasonable discount rate and terminal growth assumptions, the hurdle stays high. That growth path takes unlevered free cash flow from $22 billion today to approximately $88 billion in year 10, 4 times the current level. Watch it compound. Year 1 already needs roughly $25 billion. By year 5, approximately $44 billion. Each year building on the last with no year off. That target has operational consequences. Holding the current estimated unlevered free cash flow margin at 58.3%, Visa would need approximately $150 billion in annual revenue by year 10. The market is not pricing in one more strong year. It is pricing in 10 years of sustained delivery. But does our own forecast produce the same value? Now I forecast the business itself, $44 billion of trailing revenue, and how much of it turns into unlevered free cash flow. The base path starts at 10.9% and fades toward 4.5%. That is trailing revenue growth blended with forward analyst consensus. Cash conversion has real room to improve, from 48.7% of revenue today toward 58.3%. With a 10.4% discount rate and 2.5% terminal growth, that produces $224 per share. That discount rate is a market value weighted average cost of capital built from a 4.6% risk-free rate, beta of 1.3, 4.5% equity risk premium, and 3.3% pre-tax debt cost. About 54.4% of modeled enterprise value comes from the terminal value, so the result remains sensitive to long-run assumptions. The bear case starts at 9.2% growth and assumes cash conversion never improves at all, holding at 48.7%. It is worth $170. The bull case starts at 12.5% and reaches 60%, the best margin it has ever posted. It reaches $245. The width of that range is not our opinion. It is the spread between the highest and lowest analyst revenue estimate, and here they are unusually close together. At $369, the stock sits above even our bull case. The DCF gives us a value. The multiple tells us what investors are paying for it right now. Our final lens is the valuation multiple. Visa trades at approximately 31 times trailing earnings. Based on expected forward earnings, that falls to approximately 25 times. The gap reflects the growth analysts already expect. The company's own median across 4 fiscal observations is approximately 33 times. The broader market trades at approximately 24 times on a configured trailing price-to-earnings benchmark. But the lenses disagree here, and that matters more than either one alone. On forward earnings, the multiple looks reasonable. Measured against the free cash flow Visa produces today, our model says the price still demands extraordinary long-term growth. A fair multiple on forecast earnings is not the same as a fair price for the cash. The valuation survives mathematically, but only if a few conditions keep holding. Now the evidence. Spending volume is mixed. Revenue grew 14.4%, but the data does not isolate spending volume. Yield stability is not directly measured by the standardized dataset. International growth is supported. Revenue grew 14.4%. Return on capital is supported. Return on capital of roughly 36% against a 10.4% cost of capital. 2 of 4 are supported. Spending volume, yield stability remain unresolved. The verdict remains conditional. Now stress the model. The business risks are spending slowdown, interchange regulation, rail bypass. The screen translates them into exact valuation inputs. First, cut starting revenue growth to 70% of the base assumption. Fair value falls to $196. Second, reduce the steady-state free cash flow margin by 20%. Fair value becomes $187. Third, raise the discount rate from 10.4% to 11.4%. Fair value becomes $195. Finally, combine all three while fading mature growth to the terminal rate. The model falls to $135. These are standardized model stresses, not predictions. They show which assumptions the valuation is most exposed to. These risks do not need to destroy the business. They only need to produce results below what the current price already requires. The standardized stresses show how the valuation moves. But before the verdict, there is one counter-argument this analysis owes you. One more test before the verdict, and one important counter-argument to answer first. On a normalized historical return of roughly 33%, Visa earns 23 percentage points more on its capital than that capital costs. Sustainable growth is roughly return on capital times the share of profit reinvested. Holding that share steady, the growth this price requires would require reinvesting roughly 45% of after-tax operating profit. So capital may not be the binding constraint. The harder question is whether it can be deployed at similar returns while revenue scales to the level this price implies. 2 caveats. That identity describes operating profit, not free cash flow, so it holds only while the reinvestment rate is steady, and a past accounting return is no promise about the next investment. That is the last piece of evidence. So what do all 3 lenses say together? 3 lenses. Here's the verdict. Lens 1, the reverse DCF. The price demands 15% growth every year for 10 years. an implied free cash flow path well above what the company recently delivered. Lens 2, our own DCF, $170 in the bear case, $224 in the base case, $245 in the bull case, and the current price sits above even our bull case. Lens 3, the multiple, a multiple in line with its own median across 4 fiscal observations. The combined downside case lands at $135, approximately 63.3% below the current price. Add the 3 together and the tell is clear. On earnings, the stock is not expensive. The multiple is no warning here. The pressure is all in the cash flow. Even our most optimistic scenario cannot reach today's price, with our base case roughly 39.3% below it. This is not a rich multiple story. It's a price paying for years of free cash flow growth beyond what even our bull case assumes. So what would have to be true for today's $369 to be right? Growth far above our bull case, closer to the 15% a year the reverse DCF backed out. That distance is the expectation gap. Visa is an exceptional business. The returns it earns on capital say so. What looks expensive here is the price, not the company. Our overall verdict, priced beyond our bull case. Business quality and investment value are different questions. This conclusion remains conditional on the evidence and assumptions shown. That is the analysis. Thank you for watching. This analysis is a valuation framework, not financial advice. The result depends on the assumptions shown, and you should always verify them and do your own research. Snapshot, August 6, 2026. Position not disclosed. The description lists sources, method, and AI use.